Explanation of the 2008 stock market crash. The 2008 stock market crash was a global financial crisis that occurred in the late 2000s, primarily in the United States. The crash was caused by a number of factors, including the subprime mortgage crisis, lack of regulation, and economic conditions. The subprime mortgage crisis, which began in 2007, was caused by a large number of homeowners defaulting on their mortgages due to adjustable-rate mortgages that they could not afford. This led to a decline in housing prices, which caused many banks and other financial institutions to suffer large losses. Causes of the crash. Subprime mortgage crisis. The subprime mortgage crisis was a major cause of the 2008 stock market crash. Subprime mortgages are loans that are given to borrowers with poor credit history and often come with adjustable-rate mortgages, ARMs. Lack of regulation. The lack of regulation in the financial industry also contributed to the crash. Financial institutions were able to engage in risky practices, such as borrowing large amounts of money to invest in subprime mortgages and other securities. Economic factors. Economic conditions also played a role in the crash. The role of investment banks was also a significant contributing factor to the crash. Subprime mortgage crisis. The subprime mortgage crisis was a major cause of the 2008 stock market crash. It was a crisis in the subprime market in the United States that began in 2007 and led to a severe recession. Timeline of events. 2005 to 2006, housing prices begin to decline, and the number of subprime mortgage defaults starts to rise. 2007, the subprime mortgage crisis begins to have a significant impact on the U.S. economy, with many banks and other financial institutions suffering large losses. 2008, the crisis intensifies, with several major investment banks and other financial institutions failing or being rescued by the government. September 2008, the investment bank Lehman Brothers files for bankruptcy, which leads to a panic in the global financial markets. October 2008, the U.S. government passes the Emergency Economic Stabilization Act, which authorizes the Treasury Department to purchase up to $700 billion in distressed assets, primarily mortgages and mortgage-backed securities. November 2008, the Federal Reserve announces a series of measures designed to stabilize the financial system, including the creation of the Term Asset-Backed Securities Loan Facility, TALF. 2009 to 2010, the U.S. economy enters a recession, which lasts for several years. During this timeline, the stock market experienced massive drops in volatility, with the Dow Jones Industrial Average, for instance, falling from a high of over 14,000 in October 2007 to under 7,000 in March 2009. The global economy also experienced a sharp downturn as a result of the crisis, with many countries entering recession. How to prevent future crashes. Regulation. Increasing regulation of the financial industry can help to prevent risky practices and reduce the chances of a crisis occurring. This can include regulations on lending practices, investment practices, and the creation of new financial products. Transparency. Increasing transparency in the financial industry can help to prevent crises by making it easier for regulators and investors to understand the risks that financial institutions are taking. This can include requiring institutions to disclose more information about their investments and financial products. Risk management. Effective risk management is important to prevent future crises. This includes creating early warning systems that can identify potential risks, as well as having in place plans to mitigate or respond to those risks. Consumer protection. Implementing stricter rules and regulations to protect consumers from predatory lending practices. International cooperation. Stronger international cooperation between countries and their financial regulators can help to prevent crises from spreading across borders and becoming global issues. Capital requirement. Banks should be required to hold more capital to cushion against losses in the event of a crisis. Stress testing. Banks should be stress tested to evaluate their ability to withstand financial shocks. Derivative regulation. Regulating derivatives markets and ensuring that they are transparent and safe to use. It's important to note that these are not foolproof solutions, and it's not possible to completely eliminate the risk of financial crises, but implementing these measures can help reduce the chances of a crisis occurring and mitigate the impact when one does happen.